Hello, everyone. I'm Najeeb Baqui, founder and managing director at Tinsley Park, a private equity platform and an advisory firm. Welcome to another episode of Tinsley Park Talks, which is a global networking and leadership platform where we interview industry legends from finance to tech and from policy experts to intellectuals. In these digital interviews, we discuss great ideas around investing, entrepreneurship, solving complex problems, and all other lessons of life. Today's topic is secrets of private equity investing. And our guest discussing the topic is Bruce Macrae, my former colleague and ex-boss at Hastings Equity Partners. Bruce's background is a mix of engineering, operations, management consulting, and private equity. He started his career as a manufacturing development engineer at AT&T Network Systems. After AT&T and receiving an MBA, Bruce worked as a management consultant at the Parthenon Group, where he focused on large, small companies, as well as very large private companies. While working there for a client in Houston, he identified an opportunity to carve out one of the non-core manufacturing businesses of that client and devise a successful acquisition plan. This led him to subsequently become CEO of this business called Flow Control Equipment. After this role as CEO, he co-founded Parthenon Capital, followed by becoming a managing partner at Hastings Equity Partners. Bruce has been involved in more than 30 private equity transactions, both from buy side and sell side, and he raised over $1.3 billion in equity capital, in addition to numerous individual private investments. He has developed through experience and understanding of investment strategy, execution, and company oversight. Bruce is currently focused on search fund investing, and he's also a frequent guest lecturer at Babson College, Worcester Polytechnic Institute, and Michigan Business School. Bruce has an undergraduate degree in BSME from Worcester Polytechnic Institute, MS in Industrial Engineering from Purdue University, and MBA from the University of Michigan. On a personal note, I attribute a lot of my success and experience in private equity to Bruce. When you hear from him soon, you'll know why. He not only has a professorial style in explaining things, he's also very articulate, thoughtful, and frankly, I just admire him as an industry friend that I've known for so long and learned so much from and continue to learn from. Without further ado, it is my delight to welcome my former colleague and boss, Bruce Macrae. Welcome to the show. Unmute, sir.
Thank you, Najeeb, and thank you for that kind introduction. I appreciate it. I always enjoyed working with you, and it was one of the better decisions we made when we hired you. So it's good to reconnect and see how you're prospering, doing well with Tinsley Park. So delighted to talk to you about private equity and share with you whatever insights you think would be worthwhile listening to.
Thank you, Bruce. I just started this podcast. You're my third guest, and I'm truly humbled that you joined. We've known each other for almost a decade, almost half a decade now, not a decade yet, but I've learned so much from you, and I'm just really pleased and thankful that you joined. So today's topic is private equity investing, and you've obviously been a private equity investor for most of your career, a successful one at that. We've worked together. I'm very fortunate that I've had an opportunity to work with you and learn from you. You trained me. I remember when we got hired. When I got hired at Hastings. So, today, I guess I gave a really broad intro on you, your academic side. You want to talk about the Bruce Macrae that I didn't mention in the intro?
Sure. So just background, I grew up in Massachusetts, and interestingly, as a New England kid, on a professional life, I spent a good chunk of my time working in Texas and Southwest. Which is probably something I wouldn't have anticipated when I got out of college, but have enjoyed my time immensely down in the Southwest. Today, I'm living on Cape Cod, where summers is a nice place to be. Winters get a little dreary and cold, but it affords me a chance to kind of relaxed a little bit as I'm kind of in the, eighth, ninth inning of my career. We'll talk a little bit more about this, but I'm starting to get into another niche private equity investing in searchfund, which I'll talk about in a little bit. I enjoy having time to do some things outside of my day-to-day job.
Yeah, no. So when you said you're on your ninth inning, I don't know if I believe that.
Yeah, the game will go into overtime. That's for sure.
Right.
But I'm at the point where work will always be something I want to do. It's just a question of whether I've got to, be at a desk managing organizations every day, or I can pick and choose my opportunities without having to, be on a clock. So it's nice to have a little bit of flexibility in schedule. For sure.
I'm sure COVID kind of accelerated that flexibility in an indirect way.
Yeah.
So Bruce, would you like to share with our guests your upbringing and, what events shaped your life, your academic career, and the journey? How did you sort of stumble into things and where you are today?
Well, it's a long story, and I'll try to keep it very short. But, when I was a high school kid and having to think about college, I really, as I sit here today, knowing what I know, I was basically clueless. But I liked math and science. Those were always subjects that I took a lot of interest in. So that kind of led me to a path to go into engineering. And so I went to a small engineering school up here in the Northeast, WPI. And, it was an interesting experience. I never quite knew what engineers do. I just knew that the technical side was something I always thought was interesting. And, had never given my career at that time a lot of thought per se, but I did start to have some seeds of things that were going to be more kind of long-term goals. And that was, I had family friends who ran their own companies, and I always admired those folks that, had their own business, started their own businesses, and were working for themselves. And so, down deep, that was, I think, an underlying objective of mine was to someday run my own company, be my own boss. And, and that in the background kind of influenced a lot of decisions I made as I started my career. As you mentioned in the intro, my first job, I was an engineer for a while, specifically working in a manufacturing operations environment, developing, at the time, computer integrated manufacturing processes. We're trying to use technology in an advanced way to improve the efficiency of how we build product, manage a complex environment, and had a lot of fun. It was a great development experience. I got a master's in industrial engineering, which was a deviation from a mechanical engineering background that started getting me a lot more focused on operation management, which is something I found I liked a lot. And eventually came to the conclusion while I was at AT&T that I really needed to learn more about how businesses operate. And I was getting good hands-on from a manufacturing operation, but I recognized that there was a lot more I needed to learn. And that ultimately led a decision to leave AT&T and return back to school for an MBA.
Right. That was going to be my next question. How did you pivot from being an engineer to an investor? Yeah.
And so that really is a good segue. While at business school, again, you're confronted with the, decision of like, what do you want to do? What is the focus you want to have with your career? And again, I knew exactly what I didn't want to do, but what I wanted to do was still a little bit in the fuzzy focus. Again, as I said earlier, the back of my mind was I wanted to prepare myself and develop a skill set and experience where I could feel comfortable running my own company. Mm-hmm. So after business school, I kind of pivoted away from the engineering world and into the management consulting world, which I thought at that time would give me more of an accelerated exposure to broader management issues and really learn from a perspective of how you create value in companies and see different industries, different companies, address different problems, but really start to get a perspective of the CEO. What is it that he or she has to think about running an organization, from people to process to strategy. And so I thought the management consulting path would be a good way to get that higher level view, and again, kind of on the job training for something that eventually I would hope to do in being in a senior leadership role.
So after you finished your MBA, you joined Parthenon, which was a spin out of Bain and Company, correct?
Yes.
Want to talk a little bit more about the experience there? How did you hook up with those guys, and then what? Tell us about that experience that you had that led you to the next opportunity.
So while I was in my early days of management consulting, I had an opportunity through one of my former bosses to join a small startup consulting firm. At the time it was called Talisman, but it eventually changed its name to the Parthenon Group. And the background on Talisman / the Parthenon Group was it was a Bain spinout. It was founded by two of the senior managing partners of Bain, and they had a view of building a kind of a boutique strategy consulting firm that would also evolve much like Bain Capital did, being spun out of Bain. So there was this kind of longer term view of the Parthenon Group doing something similar, which was attractive to me. You know, without thinking about private equity as a career path, I certainly was intrigued by that opportunity or the potential opportunity. But at the time, also recognized I still had a lot to learn about running companies and how to understand value creation. So the opportunity presented itself. I took it, and again, you don't know where these roads always lead to, but sometimes you just have to put yourself into a stream and see where it takes you. One of the things about the Parthenon Group that I thought was an interesting quality as a small, young consulting firm is that they were opportunistic in looking at situations very differently than a traditional consulting firm. For example, they had a couple of clients where instead of taking their fees in cash, the way any consulting firm would do, they take them in equity. And the idea was, if we at Parthenon are good at our advice and help change the value equation, then we could benefit from the upside and effectively have skin in the game. You know, we'll put our money where our mouth is. And Parthenon had done that very successfully a couple of times. And so it was this very interesting environment that was operationally, strategically focused, but at the same time entrepreneurial and thinking about how to play the game differently and how to take advantage of situations. And so it had this very interesting culture, which I thought, as a young guy learning, you know, the ropes of management consulting, it just provided a different perspective on the business. And it was while at Parthenon, we were consulting for a large privately held company, family business. And I was assigned to work on a couple of their divisions that happened to be focused in Texas. So, you know, in the early 90s, I found myself on planes heading down to Texas, heading down to Houston to work in the oil and gas sector of their businesses. And it was while I was doing the division level consulting work on this company's businesses that the small manufacturing company down in Houston was a candidate to be divested. And while working with the management team, we had identified a couple of ways to grow the business, primarily through acquisition, and led to an interesting concept to go back to the CEO of the parent and say, look, you've got the small little division. It doesn't really fit your portfolio. You should sell it, but there's a chance here or an opportunity to take advantage of an acquisition that could enhance value. And if you sell the business, somebody in the market's going to buy that company, buy your company, and they'll get the benefit. So the idea was, why not execute kind of a two-step exit and take advantage of this acquisition, get it done, and create the value, and then sell. So all that plotting, I was in the middle of kind of organizing, and eventually get the CEO to go along with the plan. He got approval from his board. And this was my first step into kind of the M&A world. You know, I had a hunting license, so to speak, to go out and see if we could actually put a deal together. We had the division, which was about to be sold, but the contingency plan was if we could get this company, this acquisition target under LOI, then the CEO was prepared to buy it, merge it, and execute the plan we put together. And that ultimately is what afforded me the opportunity to go and become kind of an M&A deal acquisition person with no experience. I mean, I jumped into the pool and didn't know how to swim, but you don't let that get in the way.
Bruce, how many years out of business school was that?
About 5 years. About 5 years.
So 5 years of management consulting experience under your belt, and then you took on this. Okay.
And it's funny. One of the things I tell people about this experience is, as a consultant, you're basically focused on the income statement. How do you grow the top line? How do you grow profitability? Right? All the things that go into that discussion. Mm-hmm. What you never really think about as a consultant is the balance sheet.
Right.
Well, when you get into the M&A world and start acquiring companies, all of a sudden you realize there's this thing called a balance sheet. And it becomes very relevant to what you're trying to do as part of the overall process. So, right. You had to learn real quickly about the different dimensions about thinking about value creation, and not just, the foundational part, which is the income statement business growth, but you also have to deal with all the other complexities that come with it in terms of understanding how to put deals together, how to structure deals, how to use the balance sheet, particularly when you're going to be using leverage. So it was a bit of baptism by fire for me to do all this. And ultimately, the CEO of the parent company liked me. He liked the plan. And he offered me the job as CEO to execute this whole deal. And that really was the first step of me having kind of created the situation where I could take a leadership role and move from consulting, which I call on the sidelines of the game, into the game to be a player. So I accepted that opportunity gladly, and had a chance at a young age with a limited amount of experience, moved down to Houston and became CEO of a manufacturing company.
How did your seniors at Parthenon Consulting take that opportunity that you received, and having to leave a job full time to pursue it in a corporate level?
Well, all this was actually done in a very structured way with Parthenon Group. So effectively, the entire deal opportunity was being presented and packaged as Parthenon Group leading this for this client, this large family-owned business. And I was the point guy. So I became CEO, but in many respects, I was seconded. My employment left from Parthenon. Sure. I went to the company, moved down to Houston. But at the same time, it was a very strong Parthenon Group-driven initiative. The three of the 7 board members, myself included, the other 2 were senior partners at Parthenon Group. So Parthenon Group was very much involved in the whole deal. I basically ran it, executed it, but they were clearly a part of this. So it wasn't just getting up and leaving Parthenon.
Sure.
There was a strong ongoing set of relationships that were part of this.
This was what you mentioned earlier as Parthenon liking to have skin in the game. So this was their skin in the game.
This was even more than skin in the game. I mean, this was not a consulting assignment. What we did was, just to kind of simplify it, is we presented the opportunity to the parent CEO, our client, as a quasi leverage buyout, and effectively treated the structure of the deal as if we, Parthenon Group, bought the company with our own capital and executed the deal. So we basically followed the private equity playbook. The parent company actually continued to own the asset, but when we executed the strategy, we took this division and we separated it into a separate company, incorporated as a standalone business. So we get it removed from the corporation.
Right.
We had control of the business, and then Parthenon Group effectively had what I'll call a promote, a traditional, GPLP kind of promote.
Right.
So that we were rewarded for the value creation, and then I in turn had a chunk of that, which was my true skin in the game of executing.
Sure.
So it was really kind of a private equity-esque playbook that we followed in terms of how we put the deal together with the parent, client, and how we executed it. And it was a leverage buyout. We used leverage to buy the acquisition that we're going for, so we had to raise debt. And again, it was a private equity kind of playbook deal 101.
Great. And so I guess this is a great segue to how Parthenon Capital was born.
It was. So just to back up for a second. So the company I ran, it basically made oil field equipment. And we were able to double the size of the business from about 30-ish, 35 million to about 70 million revenue in 2 years. The acquisition we did probably contributed of about maybe 7 or 8 million of that 35 million growth. The rest of it was execution on expanding our geography with a big Canadian operation, expanding our markets, expanding our product lines. So it was both organic growth, but with the acquisition as the catalyst. But the real driver of the value was that we took the EBITDA of the business from about 3.5 million to close to 16 million run rate in 2 years. So we had a tremendous growth curve and leverage on our EBITDA. And again, this was set up to be really a kind of a two-step exit. You know, the original intent was that this division was going to get sold. This acquisition was a catalyst to create value. So do it internally before selling.
Right.
But when I got into the business, and this is just having a good operating background, there were lots of other ways to improve the growth of the business, both from a cost management as well as from a revenue generation.
Right.
And the oil patch at that time was going through a lot of transition. It was consolidating. We had our own product lines, very good strength with distributors. And so we ended up on the winning side through a lot of creativity in how we put together marketing programs, expanding product offerings. And all that culminated in a very rapid growth of EBITDA. And so, best guesstimate would be if they had sold this division when it was originally decided to be sold, that probably would have been a 20 million-ish value. You know, it was a sideways, low growth business, 3.5 million EBITDA, maybe you sell it for 6 times. We ended up selling it 2 years later to a public company that had a big oil field division, and they wanted to take advantage of our assets, our manufacturing, our Canadian presence, and they paid us 110 million in cash. So effectively, in 2 years, we created probably on the order of 80 to 90 million dollars of value,
enterprise,
which was a tremendous, tremendous success. And on the basis of that, Parthenon Group, which had always had the aspiration to develop a capital investment arm very similar to what Bain Capital did, this deal became a catalyst for that. It was a proven data point in terms of the ability to take a kind of an ordinary business. There was nothing sexy going on here, but through a lot of operating strategic moves, create tremendous value in a very short period of time. And being at the center of that and executing it, personally, it was a phenomenal experience for me. I had a hell of a great time doing it. But for Parthenon, it was the time to take the next step and try to go out and leverage this experience to raise a capital fund, which was the genesis for Parthenon Capital. And having been at the ground floor, I became one of the co-founders of that initiative with one of the 2 managing founders of Parthenon Group, who was spinning out from the consulting to take the lead on the capital side. So all that was taking place in the kind of late 90s, 1990s.
That's a great story. Obviously knew bits and pieces of it from knowing you for so long, but yeah, that's a great outcome and sets you up for everything else that you did after. So which would love to hear. So you said this was late 90s. So this was a really good time in American history economically, right? We're blowing and going economically. Tech bubble forming. Nobody knew it was a tech bubble.
This was the advent and the age of the internet.
Correct.
Causing all sorts of interesting things, both good and bad, in public markets and company transformation.
Yeah, so that leads me to ask you the next question that I put together here about managing through crisis, right? Secrets of private equity. So the secret lies not only in doing everything successfully, but also navigating around negative events that you cannot control. And I think you were approaching that 2000 crash, let's say 2001. So how did you, this is a broad question, but how did you manage through the crisis of 2001, and I know later in 2008 you had to do it as well. So why don't you give me like a two-part answer to that question?
Well, so let me give a little context. When we started Parthenon Capital, we raised a $350 million debut fund. And we had a team that was relatively inexperienced at the private equity investing game. You know, a lot of smart people. We had three kind of co-founders. One of them was a very seasoned private equity guy. But the rest of us had been involved in all sorts of aspects that surround private equity, but we'd never managed a private equity portfolio in the traditional sense. And so there's a bit of a learning curve going on. And you're right to point out that in the late 90s, the markets were a bit of a go-go with the internet affecting all sorts of issues around valuations, around transformations. Just very interesting time. Very interesting time.
Hey, Bruce, sorry to interrupt, but when you raised that $3+ billion fund, you mentioned a team that didn't really have a lot of hands-on PE experience before. You know, how difficult or easy was it to raise a private equity fund at that time? Was it because of the sort of this whole boom thing going on, people are throwing money everywhere, or like what was the sort of climate?
It actually was quite easy.
Oh, really?
Probably too easy, quite frankly. So the story that we were raising capital behind was that we were Bain Capital Redux. And Bain Capital had gone out and raised from funds that were in the $100 million to $2 million range with just phenomenal success. Mm-hmm. They moved up market to $1 billion funds. And at the time, getting into $1 billion fund in the late 90s was a pretty sizable fund. Today, $1 billion fund would be considered modest, right?
Right.
But they were basically forcing themselves to have to do bigger deals. And so we kind of came in behind them and said, we're basically Bain Capital Redux. You know, we have the same capability, same strategy, same DNA. And we're going to be the guys that focus on the same value opportunity of taking ordinary businesses and turbocharging them. But We'll stay in that lower side of the market. And so one of the co-founders, who was the more experienced guy, he had a very strong private equity track record. So between the Parthenon Bain connection and his track record, we found raising capital in our story, particularly bolstered by what I had just accomplished, to be a very persuasive sell. And it was all institutional. And in fact, we capped at 350 because we could have raised more. But we knew we weren't set up organizationally to manage more than that. So we limited ourselves, even though we could have been a bigger starting fund. And it was a challenge. I mean, out of the gate, we had a lot of people around the table with a mixed experiences. But we had to learn as a team how to become good private equity investors and really do a lot of self-development training, really focus as a team on combining the skill sets and experiences so that we could do a good job. And that it made a very tight culture, and that we're in this together, as opposed to a bunch of people running out and doing their own deals and kind of having lunch together or a meeting every now and then. I mean, we were truly operating as a group to leverage the collective capabilities of the firm. Got it.
Okay, so I think thanks for answering that. So we were talking about managing through the crisis in 2001.
Yeah, so what we experienced was we put a lot of capital to work in a very short period of time. You know, from end of 98 through 2001, we had invested about 80% of the $350 million.
Wow. Were they all private investments, or were you also investing in public companies?
No, it's all private investments. And then we set out to raise Fund 2 without having any liquidations. And we're successful at closing on a $750 million fund. You know, wow. Based on a very strong mark on the portfolio, based on now we were really demonstrating the kinds of deals. Some of the deals was traditional kind of PE buyout in financial service, business service, healthcare. Some of these had kind of a .com element to it, where we're taking a bricks and mortar business and putting an internet capability to it, and taking advantage of both valuations in the public markets as well as growth strategies. So things were going phenomenally well. And so at this point, our team from initial 3-4 of us, we had probably 20 people, opened up a West Coast office, had now raised about $1.1 billion in 4 or 5 years, had a portfolio of about, 15 to 18 companies. And as they would say probably, we were just blowing and going.
Right.
And it was all going really well until it wasn't. And what happened? Well, for those who remember 2001, first of all, we had 9/11. In fact, we had our annual limited partners meeting going on that morning at a Boston Harbor hotel overlooking Logan Airport, where one of the planes, or I guess one of the planes had taken off from.
Right.
And had to stop our meeting mid-course to announce to people that planes had just crashed in buildings in New York. And we had CEOs we had investors from all over the country. We had about 150 people at our meeting. So it was one of those moments. Where were you? Well, we were sitting in our annual limited partners meeting. Very, very, in hindsight, interesting time, but certainly shocking what happened.
Right.
But what that led to was basically the bloom of the dot-com faded, the economy cycled down, and we had a portfolio of companies that were levered. And what we experienced over the next kind of 2 years was the tumult of learning to be a private equity investor, which is when things go bad, you have leverage and you start seeing where the weak management teams are. You now are confronting with a crisis of financial risk combined with market and operational risk. And the job goes from not just investing new capital, but trying to make sure you keep alive those companies in which you're invested in. And dealing with banks, dealing with workouts, dealing with management teams that are showing weakness and need to be replaced, all the elements that come into play as a private equity investor. Sometimes the grass isn't always greener on the other side. And it was a very painful kind of 2-year process post 9/11, 2001, as the economy was going through this down cycle. The other phenomenon that was going on, and Parthenon Capital was an example of this, was that in the late 90s, there's a tremendous amount of capital that was raised in the private equity. As an asset class, private equity through the 90s really developed itself into an institutional niche that transcended just the small firms doing deals. It soon started to expand very rapidly, and the capital flowed right in from the markets. Mm-hmm. And so by 2002, 2003, what we're experiencing was that there was a big overhang of private equity funds. And with the economy cycling, you found that good deals were rare. I mean, finding good deals is always rare, but right. There was an imbalance between supply capital and the availability of investment opportunities. And that results in, a seller's market. You were seeing very high purchase prices for companies. And of course, how do you play that private equity game? You tend to start using your balance sheet to put more leverage on the business. That in turn puts a lot more financial risk on the company. And having just come through a situation in the last few years with a balance sheet, with a portfolio that had a very leveraged balance sheets, it wasn't that appetizing to think we're going to start playing in a higher price game, over levering and potentially perpetuating the problem we find ourselves trying to fix.
Right.
And so it was a very unique time, but more emblematic of the private equity game where, leverage and returns go hand in hand, but the risk you start managing is directly proportional to the debt you want to use. And that debt is a function of what price you're going to pay. And as a private equity person new to the game, you start getting a much more intrinsic feel for those dynamics, as well as you need to have a much more credit view, which at Parthenon Capital early on, as people that were consultants, I would say one of the key learnings is that we didn't have a strong enough credit view of our investments. Everything was more driven by equity revenue growth as opposed to how to think about risk management and downside from a credit standpoint. And I would say that was a bit of Achilles heel of ours coming through that cycle. And something as a young private equity guy became a very important learning for me, that you need to have a credit focus on the investments as well as your investment thesis equity focus. You can't look at these in absence of one or the other.
Very, very good point. Did you have similar experience in 2008?
So 2008 was, it was similar in many respects. I mean, people can remember we had the credit crash of really the bond market and the housing market. And so it had probably a more severe shock than what we saw in 2001.
For sure.
I think 2001 was a recession, but it was also amplified by the .com failing going on. So it didn't have the same macro collapse that we saw in 08, but there were similarities in terms of the rapidity of how fast things decline. In 08, of course, when you go back and think about those times, what we see, like a 25, 30% loss in the stock market one day. It was cataclysmic, and it was across the board. Now, there are a couple things that happened then. One is that because it was a macro shock to the world economy, interestingly, lenders were much more forgiving on covenants. And again, you've got a portfolio of private equity companies, you've got leverage, and all of a sudden you know your performance is going to suffer. You don't know by how much, but you got leverage, and leverage is a fixed, P&I that you've got to make to a company, right?
Correct.
And so banks were much more willing back then to what I'll call extend loan terms, kind of forgive on covenant blows, because they knew that if they were just try to start enforcing compliance, that they would be in a rash of trouble with companies being handed over to them. And the banks don't want to run the companies, right? They're not positioned to run companies.
Right.
So the banks made a true business decision, said, look, we'll work with the private equity guys. We'll let them run the companies to protect our credit, knowing that at some point we may get out of the cycle, but let the private equity guys, sweat and toil, be the labor that preserves our loan. Whether they make money at the end of the day, we don't really care, right? So you had a very interesting dynamic that everybody was in soup together. And that was, if this down economy was affecting everybody in every industry. So it was a very interesting, dynamic that is different from like the 01, where the 01 was the banks were very much demanding fixes to covenants, which means they want private equity firms to put more equity. And private equity firms don't want to put more equity in unless they think the company's going to live. They're not going to throw good money after bad.
Right.
And when you, as a private equity investor, tell the bank you're not going to put equity into a leveraged loan that's not performing, the gloves come off, the knives come out.
Right.
You're telling the bank that you're not going to support the company, and the bank's attitude is, well, then why should we support you? Why should we support the company? You're not going to do it.
Yeah, 2008 was different in the sense it was a banking crisis, and it was the great deleveraging. And a lot of the write-offs were already kind of given that they had to do that in order to rebalance themselves. And with new regulations, new banking regulations, compliance, as an overhang in front of them, also forced them to just kind of deal with their incumbent deals and customers with more flexibility, I think. So,
but let me just say this, just as a general portfolio management strategy, we learned a lot of this in the 01 crisis when the 08 came, which is, as a private equity investor, you're ultimately, you own the companies and you're responsible. Right. And so you need to be swift of foot when you see the crisis coming. And when it comes, you need to be even swifter to take action. And that action is around getting as much cash out of your line of credit as possible. You want to draw that line so you've got cash in the bank. Liquidity, right? Two, you've got to go to your expense structure really fast and really deep and get the organization right-sized before it needs to be right-sized. One of the biggest problems everybody makes, or mistakes everybody makes, is that they're slow to address the cost side when the company and the industries are going through a downturn. And this is where you start realizing whether you've got a good CEO or a bad CEO. Mm-hmm. And the good CEOs are telling you what they're going to do, and they've already answered your question before you've asked it. They've got a game plan, they're looking at it, and they're getting aggressive. The bad CEOs are the ones that you have to call up and tell them what to do. And what I've learned in private equity is the moment I call up a CEO and have to tell him what to do and how to do his job is the moment I'm going to pick up the phone and find a replacement.
Right.
If that CEO can't see what's going on and isn't thinking about survival and getting ahead of what I'll call the curve, you got the wrong guy, woman, but mostly these times these are guys. And so this is where you see the good and bad leadership getting shaken out very quickly. And ultimately leadership through these downturns is what matters. In anything, leadership matters, but it's acute when you need to survive. And as a private equity firm, this is the very unpleasant time because, you don't do this just for love. You do it because you want to make returns for your investors. And ultimately, there's a self-interest in that. Returns for your investors are good for your pocketbook. But when you're dealing with these problems, at this point, the return side of the equation is non-existent, right? You're just fighting for survival.
Right.
You're fighting to keep the company viable and allow it to hopefully recover through the cycle, the return of the cycle. And that's a lot of hard work, a lot of stress when you're saying, gee, the economics of this aren't looking so great. So that is a very key learning as you go through these cycles, having been through a couple of them.
Absolutely. So by 2008, you're already at Hastings Equity. You've gone through these two crises, 2008 being a really big one. Can you share your insights while you're at Hastings, sort of insights on the strategy that you initially had with your partner Ted there, investment strategy, and how that evolved post 2008, and then finally after 2008, whatever other industry cycles that you experienced, particularly in energy services.
Yeah.
Can you walk us through sort of that journey?
So let me go back to 2004. So I made a personal decision when the performance of Parthenon was suffering. The market dynamics changed very quickly over the 5 years with this oversupply of capital. And one of the things I observed was that as we raised bigger funds at Parthenon, we were forced to do bigger deals. And as you move into those bigger deals, you're sticking your head up out of the foxhole and the bullets are flying, so to speak. You're having to compete for bigger companies, bigger purchase prices, more leverage. It was more financial engineering. And I really was looking at that kind of with a jaundiced eye. At the same time, a lot of interesting smaller companies were showing up on my radar screen, but the equity check would be $5 million, not $50 million. And we needed to do $50 million bets. But I was watching these little businesses that were great companies get done by small firms or individuals. And then I'd see them 2-3 years later sell and make 3, 4, 5 times the money in a much different investment dynamic than the big scale deals. And so at this point, I decided that I wanted to go, now that I really learned private equity in a way that, what I'll call battlefield tested.
Right.
I decided to go build my own portfolio and become, more entrepreneurial. I understood private equity. I had a balance sheet I could use. And in that process, I found a great company, small manufacturing business that made a specialized cable systems, a lot of government contract related, but just a good business. Only about $5 million in revenue.
I think I know the name of the business. Is it Seacon Phoenix?
It is.
All right.
Good guess. But it was an example of the kind of deal that I couldn't do at Parthenon, but I could do on my own. And it was through that deal that I met Ted Patton, who had just founded Hastings. And Ted came out of a banking background, didn't really have any private equity experience, but he was a good guy, smart guy, and had a small high net worth investor group of very interesting former CEOs that I thought was a good resource. So I brought Ted into my deal as a co-investor, and it allowed he and I to work together to see if a longer term partnership would make sense. And it did. But that deal we did, after 3 years, we sold the company, grew it, brought a new CEO in, and ended up making 5 times our money. And it was the kind of deal that was a good proof point to the value you can achieve in these smaller businesses, smaller market. And so when Ted and I really started to launch Hastings, from what Ted had started, our focus was to be industrial investors, private equity, where we had owner-founded businesses that there was a need for capital, a need for management talent, a need for more strategic thinking, and an owner who wasn't willing or able to manage the growth of the business the way it could be managed. The opportunity was not being met. So that was really our fundamental model. And what we were doing was probably being more value investors. We're investing in companies at 3, 4, 5 times, EBITDA valuations, not 7, 8, 9, 10 times.
Right.
Where we could use modest low leverage, so we weren't, stretching balance sheets. but transforming these businesses in a growth through acquisition, through just getting better management capability, better sales capability, new market entry, all the different ways in the toolkit to try to grow a business, where the owner just wasn't willing or able to do it. And so that became the core investment model of Hastings. That turned out to be a great place to put capital to work. So to answer your question, Najeeb, after 2008, 2009, when we went through this cyclical shock, this macro shock, we had about 6 companies in our portfolio. And they were all industrial and kind of design organization. One of those companies was actually an oil and gas service company. And I had the oil and gas background. We weren't oil and gas focused, but this company was suffering because of the cycle. Gas prices, natural gas prices, which was one of its primary markets where it provided services, was at a cyclical low. Part of this was economy, but part of it was this new technology called fracking was starting to take root. And the fracking technology early on in the success started to oversupply the market with natural gas, which, it's a supply demand issue, and was putting downward pressure on natural gas prices. So we had a problem with this company that was both driven by the cyclical natural gas market, but also from the macroeconomy. And as we really dug in and understood the fracking technology, we had an epiphany and said, boy, this technological innovation of fracking is a fundamental change to the domestic E&P market, which had been on a slow decline over the last 30, 40 years. And, I've been in it in the 90s, so I studied it very closely and understood it very well. Right. And what we were observing was a rebirth, regrowth of the domestic E&P. And so we were very quickly starting to look for investment opportunities where owners were in situations that the growth was exceeding their capital, their willingness to grow, and the opportunity could be multiples of what they were doing. And the owners were confronted with a situation where their customers, which were the E&P businesses on the service side, if they didn't grow with them, they would get somebody else. So the owner had a choice, either grow or be dislodged. You couldn't sit around and do nothing. You couldn't play the middle of the road. And for us, the value proposition was, we know how to grow businesses. We can bring capital to the table. We can bring talent. And owner, let you de-risk, take some capital off. Let us come in and put our sweat equity in. And as a partner, let's grow these businesses and take advantage of the market opportunities. And it turned out to be a very fruitful place to deploy capital. So 2010, we made a pivot to go from an industrial investor to an oil and gas service and equipment investor, and really jumped into that market with both feet. Mm-hmm. And that was a monumental shift to our investment strategy, not by the type of deal structures and what we're looking for, but having a secular industry focus than being just kind of more of a generalist in the industrial space.
Right. Yeah, I think the timing was great. I was still coming out of the shock of 2008, back to Texas. That's when you guys moved to Texas, right?
That's when we had to get a stronger presence, given that, the center of gravity for investing in oil and gas, obviously, is Houston. Right. We moved our center of gravity to Texas to be closer to the market. And Najeeb, that's when we met you. We were starting to shift our investment focus to the industrial downstream. And you came on board to help us with our investment strategy and thesis and evaluate opportunities. And it was a great time working with you then.
Yeah, that was a really interesting time. We had just gone through the oil and gas crisis and bust, and things were not looking so good in the shale sort of upstream space for services. And but contrary to that, the downstream space was just exploding. Cheap natural, gas price and feedstock was beneficial for the process industry. Chemical plants and refineries just had higher profit margins, and they started expanding their production facilities and capacity. Foreign companies that were once using naphtha and for cheaper feedstock reasons outside of the United States and, Asia, Europe, they were moving down to Houston and Louisiana. So it was a really exciting time to build out an industrial services, industrial products, sort of process industry focused investment strategy. Yeah.
Yep. It's absolutely right. It's absolutely right.
So we worked there for a few years, and then, we moved on. You moved on, I moved on. So I'd, like to know how life has been after Hastings for you.
Yeah. So I decided, just on the Hastings story, to basically semi-retire. Hastings was going to go raise its fourth fund, and again, have a very Texas-focused investment through the whole value chain of the energy industry. And I had been at the point where I didn't want to commit to investors another 8-9 years tour of duty. And the traveling was bearing on me. And just, I was getting a little bit, long in the tooth, and it was time for a change. So, which turned out to be, in hindsight, actually a great decision, because without knowing it, COVID hit, right? And so I dodged having to manage through the COVID morass and crisis, particularly the travel requirements that would have been necessary to manage the portfolio out of a Houston, Texas operation. So in some respects, I was lucky. And I've always come to the conclusion, in a lot of things in my life, I'd rather be lucky than good.
Absolutely.
And getting lucky a few key times has made a big difference. So that was another time, I think, the decision in hindsight, luck prevailed, but it turned out to be a prescient decision to kind of step out of the game. So to answer your question, what's life been after Hastings? So it's been great. I have repartnered with an old friend of mine, the Stanford graduate school guy. We've known each other for 15 years, and he comes out of the world of search fund investing. And when I told him I kind of was in the semi-retirement mode, he said, "Hey, you're too young to retire. I got a great idea for you. Let's do search fund investing." And I knew a little bit about it, but I didn't fully understand it. So I did a lot of diligence and research, and my partner at the time, or is today, Chris, as a Stanford guy, where the search fund model was birthed, I became enamored with it. I thought, what a great private equity investment niche that fits my skill set and my stage of career perfectly. So the question is, what is search fund investing? So basically, search fund investing is a model that was birthed by a guy named Irv Grousbeck. Irv was a guy in the 60s who, after Harvard Business School, was an accountant, starting to get an M&A before there was private equity. But effectively, he and a partner got into buying their own company. That would have been a private equity deal back in the days. This is in the 60s. And they rolled up the cable TV industry in the Northeast. And eventually took a company public. And that company eventually got merged into Comcast. And so this was the advent of cable TV. And cable TV, if you talk to Irv, he'll say this was recurring revenue. Content wasn't quite there yet, but it was a technology that had a subscription base. So it had all these nice elements to a good deal. And by the time the content showed up in the 70s and 80s, cable TV took off. And his company made him a billionaire. And Irv ended up going back to Harvard Business School as professor, and ultimately went back to Stanford as professor. And through Irv, he built a series of courses around search funding. And search funding was a term coined by Irv, that you would back a young MBA who would be a private equity firm of one person. They would get investors behind them, and that person would have a license to go out and find a deal. And when they find a deal, they would use their investors' capital. They would then become CEO when they closed the deal, and they would run the company. And they would get a GP LP kind of economics to be a 25%, promote that if they do well, they get a big chunk of the up. So they have equity in the game.
Absolutely.
And so it's a private equity model, lower middle market with talent who's driving this. And what this talent needs are supporters / investors who have done this before.
Right.
As a new MBA, when I came out of school, I didn't know anything about M&A. I didn't know anything about how to find deals. I didn't know how to structure deals. I didn't know how to run a company. But I was a guy that wanted to do all that.
Right.
And I eventually started doing all that. And like a lot of things in business, it's very experiential. You need to do it many times when you start really figuring out what the drivers are, what the risks are, how it works. And so my partner Chris got me excited about the search fund, where I could be now an investor and apply my experiences and be supportive of young MBAs, be a mentor to them, be an advisor to them, be a backer from a capital standpoint, and allow these young folks like me. When I did this operational CEO role at Flow Control, I was a bit of a search funder, the way the parallels. And I had a great supporting cast around me of guys like me back then who were, 40, 50-year-olds that were very successful business guys that, rose to their level because of talent. And so Chris convinced me that this was a great way to give back and invest. And I said, I'm in.
Great.
So right now the focus is on search fund investing and to accomplish all the things I just said, to be a mentor, advisor, and investor in small middle market companies that are very similar to things that we would do at Hastings. So that's the venture I am now focused on.
So what advice do you have for those entrepreneurs, those young folks that are looking for a partner like you? What should they have?
The good news is this: the search fund investment community, this has been going on for 30 years. And the results over 30 years, and Stanford, by the way, anybody who's interested in this can go on Stanford Business School and get a biannual report that they do on the industry. They survey the whole industry. Since most of the search funds came out of Stanford in the early days, but now the search fund model is gaining traction in every top tier business school in the country. So it's no longer exclusive to Stanford, but Stanford has done a terrific job at creating a definitive report on all aspects of search fund investing, including results. It's a terrific report. In fact, there's nothing like it in private equity. But the results over 30 years have been phenomenal. Cash on cash returns to investors well over 3 times, IRRs that are in 30%. If you look at private equity rankings, the search fund niche would outperform every other private equity niche that I can think of by a mile. It's phenomenal.
Yeah.
So there's a lot of good investors who have been part of this that have kind of the Stanford background, but it's expanded. And this community is always looking for talent to back. And it doesn't necessarily have to be a Stanford MBA. It could be anybody from a top business school, but you're also seeing young entrepreneurs who have the desire and ambition to do that without an MBA, but they can plug themselves into this environment and get traction. So what's the advice for young people? One of them is, if you really want to run your own company and gain this experience, this is now an avenue that's open to you. It's a very established path, and the community is out there, and it's a very supportive community. What you need to do is plug yourself in. But once you're plugged in, the community is very willing to give back. So that's one avenue for people that want to get into the investment side. And this is, again, a different model. This is, Harvard coined the term entrepreneurship through acquisition, ETA. Stanford, who was first to the game, calls it search fund investing. They're both the same thing. But the acquisition through, or the entrepreneurship through acquisition, I actually like that coinage because it's a very entrepreneur-driven model, not starting something up from scratch, but going out and finding a company, negotiating, and then you're going to run it.
Right.
And that takes entrepreneurship, right? Entrepreneurship just doesn't mean start from scratch. It means taking an initiative on your own where you're going to drive to success. You're going to be the person who is master and commander, and you're going to have to pull capital together. You're going to have to find businesses. You're going to have to build teams. I mean, you're going to have to do it's a full private equity investment cycle. And that takes entrepreneurship, right? It only happens if you choose down that path and have the determination and ambition to make it work. So that quality will self-select a lot of people out. A lot of people don't want to do that. A lot of people are very comfortable to go work in an investment bank or for a consulting firm or take an industry job that's very secure. And that's fine. Those are great careers.
Right.
But the entrepreneurship of this is, if you succeed, you can make 10, 15, $20 million, which is an opportunity that only happens if you're successful on your own initiative. And that's what attracts a certain kind of a person into this path. So that's one way to get into it. If you look at private equity investing from the generic private equity, I get asked this question a lot. How do I, as a young professional, get into private equity? And the answer is, there is no real answer. I mean, there's a traditional path. If you go to a top tier college and you go to a top tier investment bank or a top tier consulting firm,
Right.
you at least get the pedigree to qualify for an interview at some of the big firms. But there's a lot more to private equity than just that route. The other way I tell people is that if you want to be in private equity, you need to have a game plan that may have a longer timeline. But it starts with really understanding how to operate and run companies. And so at some point, it behooves you to get real operations experience.
Right.
You know, one of the problems with the private equity investors that come through what I'll call the top tier university, top tier business school, they consulted, they were in private equity is that they've never run anything. They've never been put in a position of accountability to drive revenue, to drive costs, to drive an operation. They've just never done it.
Or manage
smart people, but they've never done it.
People. Manage people. Absolutely. Or deal with people from different walks of life. Not necessarily.
Or be able to have a conversation with an owner of a business that demonstrates you understand the key issues and risk and opportunities as he or she understands it by having to live it with it day by day. One of the things you learn in private equity very quickly, Najeeb, is that one of the key skills for any good private equity investor is salesmanship.
Sure.
People always think, well, salesperson, that's a less prestige position. Well, salesmanship to me is one of the most successful characteristics of everybody in life.
You know the acronym for that, Bruce?
No.
ABS.
ABS?
Always be selling.
Always be or ABC, always be closing.
Right.
Yeah, ABC. Yes, I do know that. Was a colleague of mine gave me that one a long time ago. But anyways, you have to sell yourself. You have to sell an owner of a company to want it to work with you by demonstrating your competence,
right,
your gregariousness, your likability, but ultimately convince them that their company that they've built and grown, that you as an investor are going to be a responsible steward to take that company and allow it to thrive and succeed. Private equity guys get too much of a bad rap of being kind of the Vikings, right? It's the pillage of rape and burn. Nobody in the private equity wants to go into a company to invest in it to only turn around and lay people off. That's crazy.
Yeah.
They may have to do that as a responsible owner when things go bad, but that plan is never that. The plan is to always grow, add people, grow the market. And the plans don't always work out, but that's real private equity.
And that's where leadership comes into play, right, Bruce? You set the culture, right?
Absolutely.
You set the culture that way, then, you have less toxicity because there's a lot of that in the business world. Well, we're coming close here to finishing, but I guess you answered a lot of the questions that are, I had here kind of integrated into the ones that were you were answering prior. I guess before we leave today, why don't you tell us what success means to you, Bruce?
That's a very existential question. What does success mean? I don't know. Success is doing well in a way that you feel good about what you're doing, right? I mean, there's a professional success of, being able to achieve your goals, your career ambitions. There's personal success around your family and being a good person in the community, giving back, a good friend, helping people when they need help, but also mindful that you have responsibilities and need to make sure that you get a balance in both your professional world and how you can be ambitious and achieve, but also in your private world and making sure that those two, stay in sync at some level. There's no formula, right? At the end of the day, you want to be a good person, do well by others, and you'll find that opportunities tend to open up as people recognize that you're a good person with whom they want to do business or have a relationship with. So I don't know if that answers it, but that's kind of my simple thinking on such a philosophical question. What is success?
I think that was amazing. Thank you, Bruce. This was a pleasure.
Najeeb, great to reconnect. Good luck with your venture, and thanks for having me on the podcast. I enjoyed it.
Talk soon.